welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Ellen's economics correspondent. Each week, I dive into the morass of top economic news stories and fish out compelling narratives, or I retrieve fallacies that have been accepted as conventional wisdom by the swamp creatures for years. This week, inflation or market crash. The Federal Reserve picks its poison. The Federal Reserve completed its rather eventful June Federal Open Market Committee meeting. Suffice it to say, the financial markets were not anticipating what transpired during the monthly powwow of monetary policy makers. According to the statement from the Federal Open Market Committee, the Fed left its benchmark interest rates unchanged at 0.25%, but the so-called dot plot, which the Eccles building utilized to signal its outlook for the path of rates, highlighted that the U.S. Central Bank will pull the trigger on 2 rate hikes in 2023. This would be 1 year ahead of schedule. The Fed also increased its inflation expectations. The Fed now projects that inflation will climb to 3.4% this year, up a full percentage point from the previous estimate in March. It also kept quiet on the future of its ultra-aggressive bond buying program of about $120 billion per month. In a post-meeting press conference, Fed Chair Jerome Powell said that the fate of QE depends on the economic data. Based on some of the numbers as of late, it could look like QE will be here a little while longer. That said, was any of this really surprising? It was a no-brainer that the Fed was not going to agree to a rate hike at any point this year. Now that no rate hikes are on the table for 2021, the effects of rate adjustments typically take about 4 to 6 months to seep into the national economy. Markets can remain calm on that front. However, raising rates earlier than expected, diminishing the concept of cheap money, might be necessary to curb inflation. Also, the Fed would not announce a stimulus-dependent Wall Street that it would take away the next fix. It should be noted that 2 days after the FOMC meeting, St. Louis Fed Chair Jim Bullard told CNBC that the Fed has become more hawkish and Powell has, quote, opened the taper discussion this week. He added, quote, the chair made that very clear, but it's going to take several meetings to get organized. The pandemic is coming to a close here, so it's very natural that we start thinking about how to pare back emergency measures. Right now, the Federal Reserve will need to choose between inflation and a market crash. Indeed, printing 1/4 of all new money ever created in a year would have an inflationary effect. Liberty Nation has been sounding this alarm since the start of the COVID-19 public health crisis. And higher than expected consumer and producer prices are beginning to rear their ugly heads throughout the marketplace. Considering how unreliable the government's inflation figures are, it could be a Marx Brothers case of, who are you going to believe, me or your own eyes? The Washington establishment's evolution on inflation has been a riveting tale. It went from inflation not happening to inflation occurring, but it would be minimal, to red-hot inflation being brief, to inflation seeping into 2022. Or, as Powell told reporters, quote, as the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. On the other hand, the moral hazard of facilitating an environment of endless fiscal and monetary stimulus would eventually have horrific consequences. The equities arena is hooked on this regular injection. Investors are thirsty for a spiked punch bowl. If the central bank removes this unlimited supply of freshly created money, the stock market would experience either a substantial correction or a severe crash. Since the Fed's new quasi-mandate is essentially to eternally prop up the financial coliseum by any means necessary, the world's most powerful institution is stuck between a rock and a hard place. Inflating the money supply and recreating the 1970s, or raising rates and risking another financial crisis. The Fed will need to pick its poison. That's it for me this week. Please read my full Swamponomics column, where I look into China trying to kill the commodities boom, a new study on the minimum wage, and the World Bank, El Salvador, and Bitcoin. Thank you.
Who are we? We are Americans that believe in liberty. We are a project of the nonprofit One Generation Away. We are patriots who apply the founding principles to the issues of today.
And they keep moving the goalposts on us.
We are educators and commentators who love America and the Constitution. Who are we? We are Liberty Nation.